Imagine winning the biggest, most existential lawsuit in the history of crypto, right? And then you successfully launch this massive Wall Street ETF.
Right, the holy grail.
Exactly. You are even like piloting instant settlements with a global giant like MasterCard. Yeah. By all traditional metrics of a financial narrative, your token's price should honestly be in the stratosphere.
This should be flying. Yeah.
Instead, you are staring at a chart where your asset is literally the worst performing major cryptocurrency of the entire cycle. I mean, welcome to the absolute paradox of XRP in August 2026.
It really is a masterclass in, well, cognitive dissonance.
Yeah.
There is this complete disconnect happening right now between incredible corporate execution and just brutal tokenomics.
Yeah, totally.
And if you try to make sense of this market by looking at just the legal news or just the tech updates, you will end up completely lost.
Which is exactly the mission of this deep dive. Today, we are pushing past all the social media tribalism to really figure out the ultimate XRP crypto price prediction for the end of 2026.
A much-needed reality check.
Right, and we are pulling from a massive stack of sources for you today. We've got real-time macroeconomic market data, institutional analyst reports, and Ripple's own highly ambitious technical roadmap for this year.
Lots to get through.
We want to know if XRP is finally crossing the threshold into an institutional powerhouse, or if it is just structurally trapped by the sheer gravity of its own supply. Okay, let's unpack this, because if you look at the trading screens today, in late August 2026, the immediate price action feels, I don't know, completely at odds with the longer-term reality.
It really does. I mean, a surface-level glance at the charts this week would convince anyone that a massive, unbridled bull market just kicked off.
Oh, for sure.
Around August 19th and 20th, we saw XRP suddenly squeeze upward by nearly 14%, hitting $1.69 on just incredibly heavy trading volume.
Yeah.
But to understand that spike, we actually have to pull back from crypto entirely.
Wait. Really?
Yeah, look at the U.S. Treasury.
Right, okay, because the U.S. Treasury stepped in and doubled their long-term government bond buybacks. They moved from, what, $2 billion up to $4 billion per operation.
Exactly.
And for anyone not, obsessively watching bond markets, we should probably explain the mechanics of how that actually sparks a crypto rally.
Good idea.
When the Treasury buys back those bonds, they are essentially taking the bonds out of the market and handing cash directly to the banks and institutions that held them.
And that cash has to go somewhere, right?
Yeah.
By buying back those long-term bonds, the Treasury essentially lowers the yield, the interest rate that those bonds pay out.
So safe government debt just isn't as profitable anymore.
Right. So suddenly the financial system is flush with fresh liquidity, and institutional investors are forced to move further out on the risk curve just to find better returns. They start pouring that cheap capital into equities, tech stocks, and eventually highly volatile digital assets like crypto.
And that flood of liquidity acted like a match in a powder keg for the crypto derivatives market. We saw $1.4 billion in crypto short liquidations across the broader market.
Massive.
And let's break down what a short squeeze actually is here, because it's crucial. People who were shorting the market had essentially borrowed crypto to sell it, betting the price would drop so they could, buy it back cheaper later.
Right.
But when that macro liquidity pumped the price up instead, those traders were totally trapped.
Yeah, they are forced by their brokers to buy back the asset immediately to cover their mounting losses. And that creates this artificial wave of panic buying.
Oh, wow.
So that 14% jump to $1.69 wasn't a sudden rush of banks deciding to fundamentally adopt the XRP token for cross-border payments. We connect this to the bigger picture. It was a purely macroeconomic, derivative-driven short squeeze. It was forced buying.
Which makes the broader long-term chart look even more sobering, I think. Just days before that short squeeze, XRP had actually crashed to a cycle low, dropping under 99 cents on August 17th.
It was a brutal drop.
To put that in perspective, even with the recent pop, XRP is down roughly 72% from its peak back in July 2025.
And you have to compare that to the rest of the market, right? Bitcoin has seen a drawdown of roughly 49% from its cycle peak. Ether is down around 61%.
Wow.
Yeah, XRP has suffered the most severe punishment of the major assets.
It's literally like cheering for a baseball team that just hit an incredible grand slam in the 9th inning.
Yeah.
The crowd goes absolutely wild because the play itself was spectacular.
I love this analogy.
But then you look at the scoreboard and realize the team is still down by 10 runs. I mean, just to get back to that 2025 peak of over $3.60, XRP wouldn't just need another good week. It requires a staggering 267% gain from its recent lows.
Yeah, the math of a 72% drawdown is incredibly unforgiving. The hole is just so much deeper than 1 week of short covering suggests.
Yeah.
And if the underlying fundamental demand for the token is so weak that it suffers that kind of catastrophic drop, we honestly have to look under the hood. Structurally, the environment for XRP has supposedly never been more favorable.
Which is the ultimate irony. We were having this conversation exactly 1 year after XRP won the biggest legal battle in the history of the space.
Exactly a year, yeah.
Last August, the SEC versus Ripple case officially closed. Ripple paid a $125 million civil penalty specifically for early institutional sales, and the books were closed. No appeals.
Right, the legal doctrine of res judicata kicked in.
Which is just a fancy way of saying...
Yeah, in simple terms, it means the matter has been adjudicated and the SEC is legally barred from reopening those same claims. The existential legal cloud that hung over the token for half a decade just evaporated completely.
And we are even seeing the political winds shifting from prosecution to potential codification. President Trump recently met with crypto executives, including Ripple CEO, to discuss the Clarity Act.
Right, the political landscape is definitely changing.
This is proposed legislation that would officially categorize digital assets like XRP as commodities, taking them out of the SEC's jurisdiction entirely. Now, analysts point out that the Senate just went into recess without voting on it, so the odds of passage this year are sitting at a really slim 10%.
Yeah, it's a long shot for 2026.
But the fact that this conversation is happening at the presidential level shows a massive narrative shift.
Absolutely. Legal clarity was achieved. And for years, the dominant theory was that legal clarity was the only thing holding back a tidal wave of traditional institutional capital.
And for a brief moment, it really looked like that theory was spot on. Spot XRP ETFs launched in the US, and the initial numbers were just staggering.
They were massive.
The data shows they pulled in over $666 million in net inflows in November 2025 and another $499 million in December. We are talking over $1 billion flooding into these funds in just 60 days.
The hype was undeniable, sure, but the follow-through completely collapsed.
Wait, how bad was it?
By July 2026, those monthly inflows had cratered to just $27 million.
That is a massive drop-off.
Today, the 7 U.S. funds hold nearly $1 billion in combined assets under management. But because the vast majority of that capital poured in during the initial price spike, those funds are currently sitting on massive aggregate paper losses of over $536 million.
Okay, let me push back on that narrative, though. Because if you look at the 13F filings, those mandatory quarterly reports that show us exactly what the big Wall Street whales are buying.
Right, the 13Fs.
Institutional heavyweights are actively accumulating. Goldman Sachs alone holds over $86 million in these ETF shares. So if Goldman is buying, why is the price still bleeding out?
It comes down to the ruthless math of the ledger supply versus that incoming demand. Even with nearly $1 billion in total assets, those ETFs hold less than 2% of XRP's total circulating supply.
Less than 2%.
Yeah, we are dealing with a circulating supply of roughly 62.7 billion tokens.
62 billion. That is a gargantuan amount of liquidity that needs to be constantly absorbed just to keep the price stable, let alone push it higher.
Exactly. Think of the XRP market like a massive bathtub with the faucet running. Ripple unlocks hundreds of millions of tokens from their escrow accounts every single month.
Okay, I'm picturing it.
That is the faucet pouring new supply into the tub. The thesis was that the retail ETF channel would act like a massive drain, constantly absorbing that new supply to keep the water level balanced.
Right.
But with ETF inflows dropping from over 600 million down to 27 million, that drain is basically clogged. The faucet is still running, and the supply is simply drowning out the new demand.
So the retail ETF strategy, which was supposed to be the ultimate catalyst, has effectively stalled out against the weight of the token supply. And Ripple, the company, sees this math just as clearly as we do. Here's where it gets really interesting, because their 2026 roadmap reviews a massive fundamental pivot.
A huge pivot, yeah.
They are actively re-engineering their entire technology stack to court mega institutions directly, and they are doing it in a way that practically ignores the retail market entirely.
Yeah, if you dive into their technical documents for this year, they are transitioning the XRP ledger from a straightforward, fast payments network into what they call an institutional DeFi operating system.
Decentralized finance for Wall Street.
Which sounds like an oxymoron until you see the mechanics of the centerpiece, the XRP 66 Lending Protocol.
Right, walk us through that.
Traditionally in DeFi, if you want to provide liquidity and earn yield, you have to use a trading pair.
Yeah.
You have to lock up equal parts of, say, XRP and a US dollar token.
Right, providing liquidity on both sides.
Exactly. But that exposes institutions to something called impermanent loss. If the price of one asset swings wildly, the automated smart contract rebalances your holdings, and you can end up losing significant value.
And regulated banks simply cannot stomach that kind of unpredictable risk.
Exactly. Enter XLS 66. It introduces single asset vaults built natively into the ledger.
So just one asset.
Yes. A regulated financial institution can take a massive pile of a single asset, lock it in a compliant vault, and manage that liquidity to earn yield, which is just the interest paid by borrowers, without ever worrying about trading pairs or impermanent loss.
And Ripple isn't just hoping institutions figure out how to use the software. They are aggressively acquiring the traditional financial plumbing required to onboard them. Over the last year, they spent over $1 billion.
A massive shopping spree.
They bought GTreasury, a huge corporate treasury management firm. They bought Hidden Road, which is a prime broker, the kind of entity that facilitates massive, complex trades for hedge funds and banks.
Right.
And they bought Rail, a stablecoin platform. They are building a vertically integrated financial stack from the ground up.
And that stablecoin platform might actually be the most critical piece of the puzzle.
Really? More than the tech?
Absolutely. Ripple's US dollar-backed stablecoin, RLUSD, has exploded to a market cap of nearly $1.78 billion, split evenly between the XRP Ledger and Ethereum. The utility is phenomenal. Reports indicate MasterCard is actively running pilots using RLUSD to settle credit card batches natively on the blockchain in seconds.
That's wild. In traditional finance, credit card settlements can take days and involve multiple intermediaries holding reserve accounts. So settling those batches instantly with a digital dollar is like the absolute holy grail of payment processing.
Exactly.
Okay, wait. I'm looking at this roadmap and I see a massive fundamental problem for the tokenomics. If MasterCard or any massive global bank can use RLUSD, a stablecoin perfectly pegged to the US dollar with zero price volatility, to settle their cross-border payments instantly on the ledger.
Yep.
Why on earth do they need to hold the highly volatile XRP token? Isn't Ripple's massive corporate success with their stablecoin actively cannibalizing the utility of XRP as a bridge currency?
What's fascinating here is that you have just isolated the exact contradiction that is tearing the market apart right now.
I mean, it seems so obvious when you look at it.
Ripple is operating flawlessly as a corporation. They have a pristine balance sheet, they're executing billion-dollar acquisitions, and their enterprise stablecoin strategy is clearly working.
Right.
But investors who have been aggressively buying the XRP token, treating it like a proxy share for Ripple's corporate success, have fundamentally bought the wrong instrument.
Ouch. If you've been holding XRP for 5 years, waiting for the day major banks use it to bridge currencies, that is a really bitter pill to swallow.
It is. Every single financial corridor that settles purely in RLUSD is a corridor that moves value without ever consuming or requiring the XRP token. The ledger's technology is being used, but the native token is being completely bypassed.
So if the native token isn't strictly required for these stablecoin settlements, what happens to the billions of XRP currently sitting on the balance sheets of corporate treasuries? I mean, they bought in expecting massive institutional demand that is now being routed into stablecoins.
We can see the exact mechanics of this playing out in real time with a corporate treasury firm called Evernorth. This situation is just the perfect microcosm of the entire deep dive.
Okay, break it down for us.
Evernorth currently holds roughly 473 million XRP tokens.
473 million tokens, just sitting there.
Yes. And because of the 72% price drawdown we walked through earlier, Evernorth is staring at a massive paper loss of roughly $380 million.
That is a terrifying treasury trap. They hold this incredibly liquid digital asset, but if they try to sell almost 500 million tokens into a market where retail ETF demand has essentially dried up, they will completely tank the price.
Exactly. The slippage would be catastrophic.
And they would lock in those massive losses. They are stuck holding a bleeding asset.
And this is exactly where Ripple's pivot to institutional DeFi comes to the rescue. Evernorth cannot sell, so their strategy to survive this is to deploy those hundreds of millions of tokens into the upcoming XLS 66 lending ecosystem. Instead of just holding a passive bleeding reserve and praying the price recovers, they plan to convert that into active capital by locking those tokens into the single asset vaults.
So they become a primary liquidity provider. They take an asset that is bleeding value on the open market and they lend it out to institutional credit markets on-chain to earn yield.
Right.
It is actually a brilliant pivot to offset their losses. But all of this financial engineering ultimately hinges on where the baseline price of the token settles. So what does this all mean for the actual price? When we look at the late 2026 institutional models, the projections are, frankly, wildly divergent.
They really are. They reflect the massive tension we've been discussing, right? The incredible promise of these new institutional tools pulling against the heavy gravity of that 62 billion token supply.
Let's run through them. Standard Chartered represents the highly bullish camp. They have an XRP crypto price prediction of up to $8 per token by the end of the year.
A big number, yeah.
But they explicitly note this target requires ETF inflows to rebound massively, returning to over $1.15 billion alongside absolute strict regulatory stability.
Very tight conditions. Then we have the algorithmic, data-driven models. Coinfomania uses an AI machine learning model trained on historical volatility and current market structure.
And what do they say?
Their projection is much more moderate, placing the token between $2.65 and $5.13.
Okay, and the Motley Fool takes a much more conservative approach. They acknowledge that institutional adoption on the ledger is expanding, but they see the price remaining heavily constrained by the severe year-to-date declines we've discussed. They cap their target around $3.
Right. And finally, on the bearish side, you have technical models like CoinCodex. They are looking purely at the ongoing technical weakness and the overhead resistance from trapped buyers.
In their target.
They predict a range of just $1.27 to roughly $2.04.
Quite a spread.
It is. And reviewing these institutional targets makes it crucial to address this mathematical fantasy that completely dominates social media.
Oh, I know exactly what you're going to say.
If you are listening to this and you spend any time scrolling through crypto forums or watching retail analysis videos, you have inevitably seen the $50 XRP price target thrown around as if it's just a foregone conclusion.
The $50 meme. It is literally everywhere. People map it out on charts with a straight line up. Let's actually walk through the mechanics of that math.
We have to, because it requires a complete suspension of mathematical reality. Let's do the simple arithmetic.
Okay, let's hear it.
We established that the circulating supply is roughly 62.7 billion tokens. If you price each of those tokens at $50, you arrive at a total market capitalization of over $3.1 trillion.
Over $3 trillion.
Right. That valuation would make the XRP token alone larger than Apple. It would require a concentration of global capital that is entirely unprecedented for a digital asset outside of maybe Bitcoin.
It's the difference between hoping for a speculative lottery ticket and actually understanding structural economics. I mean, even hitting Standard Chartered's highly optimistic $8 target would require a massive, sustained shift in global enterprise adoption.
Which is exactly why the serious institutional models firmly cap their absolute long-term targets around the $10 mark. The supply arithmetic simply doesn't allow for the fairy tale numbers.
So, bringing all these threads together, what we have uncovered today is a story of profound technological resilience handcuffed to really harsh economic realities.
Perfectly stated. XRP remains an incredibly liquid, structurally sound asset. It settles transactions in mere seconds, the fees cost fractions of a penny, and it has secured the definitive legal clarity that the rest of the crypto industry is honestly still fighting tooth and nail for.
But despite all of those monumental victories, the token is currently trapped in this transitional purgatory. It is caught squarely between Ripple's brilliantly executed corporate pivot into stablecoins and institutional DeFi and the brutal heavy gravity of absorbing a 62 billion token supply.
Right. Ripple, the company, is objectively thriving. They're buying up prime brokers, integrating with traditional corporate treasuries, and piloting instant settlements with giants like MasterCard.
But they are building that future primarily on the back of their RLUSD stablecoin, effectively bypassing the need for the XRP token to act as a bridge in those specific high-volume corridors.
Exactly. The future value of the token now rests almost entirely on a new paradigm. Whether institutional DeFi protocols like XLS66 can generate enough on-chain demand and yield to absorb that massive circulating supply, turning passive corporate whales into active liquidity providers.
It is a high-stakes evolution playing out in real time, which leaves us with one final provocative thought for you to ponder as we close out this deep dive.
Let's hear it.
If Ripple successfully builds the ultimate compliant blockchain infrastructure for traditional global finance, essentially achieving the holy grail of instant settlement. But they accomplish it primarily by utilizing their RLUSD stablecoin. Could Ripple achieve total global financial dominance while its original native token, XRP, slowly becomes a relic of the past?
It is the multi-billion-dollar question that will honestly define this ecosystem for the next decade.
Thank you for joining us on this deep dive. Keep exploring the mechanics behind the headlines, keep doing the math on those massive token supplies, and always question the shifting narratives in this digital economy. We'll see you next time.